Hey guys, welcome to another episode with me, Shashank Udupa. And in today's episode, we're going to do something little different, okay? We're going to talk about something known as financial ratios. Now, usually what happens is a lot of people who talk in the industry about financial ratios, whenever I tell you something like, okay, do you know what the P ratio is or do you know what the ROE is? It might seem like heavy words, but then a lot of people might get scared because they don't know what this is. Or most of the people would just look at an equation and assume that this is the right thing to do. So in today's episode, I'm going to talk about a few different financial ratios. And how I'm going to do that, I'm going to break it down into three different parts. The first part is going to be profitability ratios, means all the ratios that are there to analyze the profitability of a company. Second would be solvency ratios. Solvency ratios basically talks about whether the company is solvent enough to run or will it go into bankruptcy very soon. Third ratio is also known as valuation ratio. So we will look at some ratios under the valuation scope as well. Now, the main reason of this video is for education and for you guys to learn. So when you look at ratios, don't look at it as a formula. Understand the entire meaning behind that formula. Don't just be like, okay, this is a formula, this divided by this. That's not how it works. You need to understand why is that getting divided by this and how, if anything, get affected from the stock market, how it affects your company. So we need to be an educated investor. So let's go through the ratios one by one. The first thing we will look at is profitability ratios. Okay, so in this first segment, we're going to talk about profitability ratios. Now, what is profitability ratios? Using these ratios, we can determine whether a business will make profit in the future, will give you significant returns in the future, or will it not be able to generate good profit. So these are some ratios that we will look at, which are very, very, very important in the industry. The first ratio that we will talk about is known as return on equity, or you would have commonly seen it as ROE. Okay, now what is ROE? As the name suggests, it's return on equity, which is basically return on shareholders' equity. So to make it more easily understandable, it is basically the net profit which is found in the profit and loss account. It is divided by something known as shareholders' equity, which is found in the balance sheet. And this is usually determined in a percentage format, like ROE is 12%, ROE is 15%, or maybe 20-25%. Now, it is basically the rate of return, okay? It is the rate of return on the money that the equity investors put into the business. So if I have put some money into my own business, what is the return I am getting? That is what ROE signifies. So basically a high ROE, or something that has a very high ROE, would determine that the business is constantly generating good amount of net profit or constantly generating good amount of profits that is giving it back to the equity shareholders. So obviously me as an investor would want more return on my own equity. That is what ROE typically talks about. Now again, this ratio is again, you have to track across different sectors. When you see some construction companies or manufacturing companies, what they do is they finance these different projects that they have by using debt. So when they use debt, the ROE can slightly get inflated at that point because the net profit that is generated at that point might actually be through the investment of debt or equity. So just something that you need to look at. Now, what I'm saying is very important to understand. ROE is different for different industries. Don't just assume ROE is the same for everyone. For example, if you look at IT sector, okay, so what happens is you have net profit, means final profit, sub karke, I've done everything and I got a final profit. Now, usually what happens is some companies that have to reinvest this and grow, like manufacturing companies, they have to take this net profit at the end of the year and say, okay, let me take this net profit and put it and make one more manufacturing facility or one more factory or one more project or one more plant. Basically, they take that money and reinvest it in the company so that that particular thing starts making more money for you in the future, right? It keeps compounding that way. So it's like reinvesting your money. The second type of companies are where it's like IT companies, right? If you see tech companies, they don't have to reinvest. They are very heavily dependent on people, and whatever net profit they make, they don't have to reinvest and make another manufacturing plant because it's not required. So if you look at all the IT firms, they don't reinvest. What they do is they give hefty dividends back. So if you look at IT firms, their return on equity is very high, right? Because they don't have to reinvest the entire money. But at the same time, if you look at manufacturing firms, their ROE will be slightly lower because they take all that money and then put it back into the company and start reinvesting it again. So this is what happens. Now again, when I reinvest it back into a factory, let's assume I've taken my net profit and put it back into one factory. The factory will not immediately give me my returns, right? Instantly. It's going to take some time. First, the factory has to be built. Then after the factory is built, we will start doing manufacturing on that factory. And only after that, a few quarters will the money start coming back into the account. And then the ROE will be calculated again. So ideally, it's always good to see if a company is constantly investing in different factories or reinvesting in back into the company. Try to look at the historical ROE and see every time this company has put a new manufacturing plant, have they got good ROE back in the future? Like in 3 months, 3 years, 4 years, have they got good returns? If they've consistently invested and consistently given you good return on equity, then it would be deemed as a good company. So that is what ROE is. I hope that was simple. Next financial ratio that we will look at is known as net profit margin. Now, what is net profit margin? Net profit margin is basically a financial ratio that basically takes the percentage of profit of a company and calculates it against the revenue. So to put it in very simple terms, the net profit of a company after everything, after tax, right? So the net profit after tax, they take that value and divide it by the total revenue. So if I have to give you an example, which is fairly simple, if a company is making 10 rupees net profit revenue, okay, at a total revenue of 100 rupees, if the company is totally making 100 rupees and then after all my expenses, it comes to 10 rupees, then I take that 10 rupees divided by 100 and that comes to your entire net profit margin. So I would say that my company is operating at a 10% net profit margin. That means for every 100 rupees, my company is earning pure 10% or 10 rupees net profit. That is what it means. Now, why is this important to understand? Because a high net profit margin, okay, especially compared to all the industry peers out there, basically says that I am a company that is doing much better than all my other players in the market. In fact, you should always try to optimize for companies that have a constant growing net profit margin. I want the net profit margin to keep growing, and the value of that net profit margin should also, including the INR value, should also keep growing. And this way, it would actually indicate that I am benchmarking against all the industry peers out there. Maybe because if my net profit is high, that also indicates that there are some people who are ready to pay me more money, or I'm operating my company in a very efficient manner as compared to the peers in my industry. So that is what net profit margin looks like. Now, there's another important financial ratio that we always track, and that is known as operating profit margin, or also known as OPM. Okay, now what is operating profit margin? As the name suggests, operating profit margin is again another profitability ratio, but it is more like a performance ratio to understand whether your company is a good company and is it optimized in a very good way. Now, what does it say? It basically says it is the percentage of profit, which is the operating profit. The formula is you take that profit and divide it by the total revenue again. But this is not net profit. What is this profit? It is the core business profit I'm talking about. This is basically all the money that you get, okay, which is calculated before EBITDA. And what is EBITDA? It is basically the entire amount which is earnings before interest, tax, depreciation and amortization. Now, depreciation and amortization is basically a practice of expensing a fixed assets and is intangible over a period of time. And also it does not come in the cash flow, but that's a whole different story. But basically, if I'm selling something and then I have to pay my raw materials, I have to pay my wages, I have to pay for everything else, and then I get a particular amount as profit, right? And after that profit, I sit and pay my bank loan, I sit and pay my depreciation, I sit and pay my taxes, and then you finally get net profit. So net profit margin we discussed before, but this is before all of that. There is something known as earnings before interest, depreciation and tax, which is known as EBITDA. This is basically my operating profit. So to find out, what I do is I take operating profit and divide it by the total revenue. That gives me a ratio. Now, the next thing that we will look at is the solvency ratios. Now, what are solvency ratios? Basically, solvency ratio is basically a key metric to measure an enterprise's ability to pay long-term debt obligations or long-term loan obligations. In simple word, it basically says, if I have taken a loan, can I repay that loan back or not? Whether the company has enough money generating from the cash flows, whether I make enough revenue in the year so that I have enough money to pay everything, all my employees, all my manufacturing costs, taxes, depreciation, I pay all of that. And I have enough money to pay the interest for my loans that I have taken. So this is basically what it looks like from a solvency perspective. Now, if the company has good cash flows and can pay back its interest, then the company is considered good on a solvency basis. But if I don't have enough money to pay my loans and I don't have enough money to pay my interest and I'm not making enough revenue for that, then the company would soon go into bankruptcy, which would be bad for you as a shareholder. Now, in this, there are two very famous ratios that we will look at. First, most famous ratio is known as debt to equity ratio. Debt is basically loan, but it's called debt to equity ratio or D/E equity ratio. Now, what is debt to equity ratio? Debt to equity ratio is basically the measure of the total debt of a company, right, against the total shareholders equity of the company. Now, where else had we seen shareholders equity in this video? In the ROE formula, right? So now basically debt to equity ratio is basically the total amount of debt compared to the total amount of equity. Now, why do we look at this? If a company has more debt than the shareholders equity, right? If it has more loan compared to the amount of money it has in its bank account, it is automatically considered a bad thing, because if I have 100 crores in debt, okay, 100 crores of loan and only 50 crores in my bank account, you know how difficult it is for a company to actually come back and pay that amount? Very difficult, right? So that would not be considered as a very good company. So that is the ratio, right? If my debt is 2 times more than my shareholders equity, the debt to equity ratio is 2, right? Now, if the company is making good amount of cash flows and I'm making significant amount of revenues and my debt is say 100 crores, but my revenue or my shareholders equity is now at 500 crores, right? So that's barely anything, right? Because then my debt is so small, but my equity is so high. So it's less than one is the ratio. Now you would ask me this question, Ki Shashank, if debt to equity ratio and debt is bad, why do companies even raise debt? Or why do they even take this loan? Or why do they even do this, right? Now, there are some people, now understand how finances work and understand how accounting works. So accounting basically works like you have revenues on top. After you have revenues, you have some basic expenses, which is your manufacturing, employee cost, operating expenses come there, and you come to this thing called EBITDA, right? Earnings before interest, depreciation and tax. Now, earnings before, remove depreciation out. Okay, now you come to something known as EBIT, which is earnings before interest and tax. Basically, how accounting works is, if you have any kind of loan and you have to pay interest, you cut it from your accounts before you pay taxes. So that won't be in the taxable income. So if I have 100 crores and I have to pay 30 crores tax, so then I'll automatically have 70 crores left. I pay tax on 70 crores, not on 100 crores. But assume I had 100 crores and I didn't have any kind of loan or didn't have any kind of debt, then I have to pay tax on 100 crores. So in a way, if you have little bit of debt, it is considered good because it removes some money off your accounts, right? It removes some money off, so you don't have to pay so much tax to the government. That is what it looks like from a accounting perspective. So it is a very nice tax deductible, interest payments are tax deductible. So that is a good thing for the company. But again, different for different industry. For example, for an IT industry, you don't need so much debt, you don't need so much loan. Why do I need so much loan? So there's no loan in that perspective, right? But if you look at infrastructure companies, right, people who construct highway and roads and toll, they need a lot of money upfront. So they have to go raise money from the market. They have to raise more debt and then put that debt to use and then wait for that to slowly get money. And once that comes and gives money to them, they pay off the interest payments. So that is how that industry works. And also, debt to equity ratio should be compared with the company in the same industry that is preferred. You can't take an IT company and compare it to a construction company and say, look, the debt to equity ratio is so different. Ideally, it is always good to look at debt to equity ratio in the same sector, right? The reason why I'm saying you look at it in the same industry is because imagine you have an IT firm and suddenly there's a debt to equity ratio of 1 when every IT firm is playing at debt to equity ratio of 0.2. So you'll be like, why is this IT company taking so much debt? Did it fund acquisitions from a debt or did it actually, take it for some other purpose? So that is how you find out. Okay, this is like little investigative when it comes to that. But why is it important? As you asked me, Shashank, why is it important? It is important for you to know how much loan is there in a company and whether the company has enough money to pay it back. That is why debt to equity ratio is super important. Now, on the same lines, okay, there is another ratio known as ICR, which is also known as interest coverage ratio. Now, the interest coverage ratio's formula is basically earnings before interest and tax, EBIT, okay, earnings before interest and tax, divided by the interest expense. Okay, if my interest expense, whatever that interest expense is there, it is earnings before interest and tax divided by interest expense. What this basically says is, if I'm making 100 rupees, okay, and I have an interest of 10 rupees, how many times can I cover my interest? Right? So I can cover it at least 10 times easily, very easily. But what if my earnings was 10 rupees, but my interest was 100 rupees? Then boss, I don't have money to pay this, right? That is bad. So basically it tries to figure out when you remove all the expenses and you say earnings before interest and tax, I'm divided by the interest amount that you have, which should be a small amount, hopefully. Then you say, okay, this company can cover the interest at least 3 times or 4 times. So anything, a higher ratio more than 1 is considered good. Anything below 1 would be considered very bad. So, okay, so this is why I say you need to understand how these ratios work. Higher coverage ratio, if the ratio is high, it is considered good because that means the company has enough money to pay it 1 times, 2 times, 3 times, 4 times, 5 times. So higher is good. But if it is less than 1, then you and I both know that he doesn't have enough money to even pay his interest. Leave alone the entire principal amount. He can't pay his interest. Now, if he doesn't do that, then it is going to be a big issue for the company. It might be going into a bankruptcy mode. And if that happens, your shareholding price will also go down. And in the end, you will lose as a shareholder. So that is why these two ratios, very, very important to look at. The first one was total debt ratio, right? Total debt to total shareholder equity. This is more from whether the company has the ability to pay its interest off, right? So this is both in the profit and loss account. That was with respect to total debt balance sheet, and both are in the balance sheet. This is a ratio that is looked at in the profit and loss account. I hope that was clear, right? So these were the two important ratios. Now in the next segment, we will talk about valuation ratios, which basically talks about how to value a company. Okay, now in this segment, we will look at what valuation ratios are. Now, what is valuation ratio? Valuation ratio basically just talks about the relationship between a company and its market value of that company. Now, how is that market value determined in the company? There are two important metrics to look at that. One pegs the entire market value to the amount of money they make, which is also known as earnings. And the second talks about the amount of valuation that they have with respect to its shareholders' equity. So we'll look at both. The first and most important metric that you guys might have seen for sure is something known as PE ratio, or price to earnings ratio. As the name suggests, price to earnings ratio is basically, if you look at it from a formula perspective, it is the market price of the share, okay, price of the share basically divided by the E, which is earnings per share. Okay, so it is basically the price of the share divided by how much the share is earning per share, like earnings per share, the net profit per share. Now, how is earnings per share created? Now, also earnings per share, if you look at it from in some websites, or if you look at it in Groww, it might be known as EPS. Okay, so that is a way to look at what earnings per share is. Now, EPS or earnings per share is basically calculated by dividing the net profit. Okay, net profit is the final profit of a company, and take that net profit and divide it by the total number of outstanding shares in the market. That gives you earnings per share. Okay, and they take that earnings per share and they take the market price of the current stock and they divide it to see how many times this company people are ready to pay money for. So, for example, if the price of the stock is say 100 rupees and the EPS is say 10 rupees, then the PE ratio would be 10 times, right? So people are willing to pay 10 times more than the earnings of the current per share of the share right now. So the company is making 10 rupees as EPS, people are ready to pay 10 times more, which is 100 rupees. That's how EPS works. Now, a lot of people have one misconception with PE ratio. They always assume a high PE ratio is bad. Okay, if it's too high, means it's overvalued and we should not invest in this company. It is bad. The best measure, firstly, to look at PE ratio is, again, you have to compare PE ratio to the industry. Okay, in the same industry. Okay, so price to earnings ratio is industry dependent. So PE ratio is industry dependent. Now, if you look at PE ratio with the industry specific dependent, there you will see that, okay, my company that I'm currently planning to invest might have a higher PE ratio than the entire industry. So is that good or is that bad? You might think, right? But let me tell you that this is a very big misconception in the entire industry, where a high PE ratio over and above the industry average, some people predict that it is overvalued right now, right? But it might not actually be overvalued. Now, there are several reasons why a high PE ratio might be good as well. Now, some of them are that the company might actually be performing extremely well and giving amazing financial numbers constantly, and maybe also giving a very good return on equity. So people are ready to pay that extra premium. Right? They're ready to, basically it's like a premium. So people are ready to pay that extra 10 more rupees for a particular stock, which increases the times. Now, investors might also have this thing that this company is the next big company, the futuristic company. It might grow very big in the next few years. So they might start buying it. Okay, they're like, in the next few years, it'll become a very big company. So I might as well buy it now at whatever rate. That is another possibility why a stock might have high PE ratio and it might be still good. Another thing which is very important, if you look at management discussions, management sometimes comes out and gives these guidance saying that, okay, you know what, in the next few years, we are planning to invest in these new manufacturing capabilities. We are going to sign more deals and it's going to become very big in the next 3 years. And also the management might be very good or capable management. So a good track record for the management and good guidance from the management can also make the stock trade in a high PE ratio. Now, if a company has usually a high PE ratio, the company might also have a competitive advantage or an economic moat, which it's helping to make this high PE ratio, right? So that is how you look at price to earnings ratio. It is basically the number of times investors are ready to pay extra from the earnings per share to value a particular stock. Again, what we did was we looked at a misconception, which is high price to earnings ratio is not bad. So please don't think that if it's high, it's overvalued and I should not buy. Okay. Now, the next ratio that we will look at from a valuation perspective, and I'll tell you why this ratio is important in some cases. Now, this ratio is called price to book ratio. Now, what is book? Okay, price to book ratio, let me tell you the entire formula. It is basically same price per share and it is divided by the book value per share, or BVPS as we know it, right? Now, book value per share is what? Basically, book value share is basically the total shareholders equity. Now, we know what shareholders equity is. It's shareholders equity divided by the total number of outstanding shares in the market. You will get book value per share. Now, this basically talks about if the book value of a particular share is say 100, I'm just giving an example, right? And the price of the market is also at 100. That means the price and the book value per share both are 100. It is trading at 1 times, right? Price to book ratio will be 1. This basically shows that how much more are investors willing to invest with respect to the shareholders' equity. Now, every time you buy something of a company or you buy a particular share of the company, you're buying the equity of that particular company. So how many times are you trying to pay more than the entire equity pool of that company is what this indicates. Now, you would say, you know what, why do we look at price to book ratio, right? And why is it good or bad? Now, this is very important when it comes to financial lending companies like banks, like NBFCs, non-banking financial corporations. In such companies, the price to book ratio is a better metric than the price to earnings ratio. Why? Because the entire banking industry depends on the assets and liabilities. So their book is so important, right? What is their assets? What is their liabilities? And the entire company, the lending companies are pegged to each other in the industry with their assets and liability, which is basically their books, right? So they look at the shareholders' equity and figure out, oh, okay, so this company has very bad price to book ratio, but there is another company that's trading very high compared to its price to book ratio. Again, is high good or bad? We'll have to check, right? Awesome, guys. So I think you guys learned a lot in this video. Basically, we spoke about 3 main types of basically ratios. One was profitability ratio, one was solvency ratio, and the final one was valuation ratios. Now, it is important for us to not only look at ratios as just what the formula is, it was important for us to understand why these ratios exist so that we become an educated investor. And when we become an educated investor and tomorrow you see some company raising a lot of loan, you'll connect the dots and you'll be like, oh, they raised a lot of loan. That means, is that going to affect their debt to equity ratio or is it going to affect their interest coverage ratio? This is something I will need to look at. So now see how educated you become and you try connecting the dots. So as I said, we're going to learn a lot. This journey is amazing and we're learning so many things on a day-to-day basis. And I hope you guys are learning with me as well. So again, if you liked this video and if you liked what was shown in this video with respect to the ratios, please like, share, subscribe and comment below. And I am very generous and very happy to look at all the comments. And again, thank you guys and I will see you soon in the next video. Shashank Udupa signing off. Hey guys, this is a disclaimer. Everything that is shown in this video is for educational purposes. Any stocks that have been mentioned would only be from an educational perspective. There is no buying recommendation from any of us, right? Thank you.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.